A lot of people feel that whole life insurance is a ripoff. At the same time, a lot of people express, I wish I knew about whole life insurance earlier in my life. Why are there two different sides of the coin? The reason why is because a whole life insurance policy can be set up where it's in your best interest or where it's in the agent's best interest. Today, I'll show both examples. So starting with a whole life insurance policy, if you just take the traditional approach, you're not going to have much cash value at all. And here's why. When you pay money into a life insurance policy, it can go toward one of two areas. The areas are, first, what is called your base premium. We'll call this premium. And then we also have what is called your paid up additions rider, or PUA rider. Now, to translate these into English, I like to call them the following. The PUA rider, I like to call a cash dump-in, and the premium, I like to call the initial insurance expense. Here's why. With any whole life insurance policy, which is a policy that is going to accumulate what is called cash value, the premium piece is initially going to satisfy the cost of the life insurance. So if you're going to pay any dollar amount into a life insurance policy, to use a round number, let's say you're going to pay a total of $10,000 per year, okay? 10K. And you'll also have life insurance, call this the death benefit, okay? So if you put that full $10,000 into the premium, what you're going to find is that your cash value is zero in the first year. Sometimes it will be zero in the first and second year. And with some companies that I would never recommend, it might be zero in cash value in the first, second, and third year. The reason why is because with any traditional whole life insurance policy, any dollars you pay toward the insurance premium do not build cash value immediately. And the reason why is because they purchase you a death benefit up front. So because I have nothing in cash value immediately, the company, the insurance company, is overcharging me for the cost of the life insurance during the early years. Whereas the PUA rider, here's why I like to call it a cash dump-in, guess what? Gets dumped into cash value. This is money you can access anytime. It can be as early as 10 business days after you start a policy, begins to earn the guaranteed rate, dividends. This is the key to accelerating the cash value of a life insurance policy. It will buy you some death benefit, but it will be very small relative to what the insurance premium gets you. Typically, you'll see if I put $1 toward my PUA rider, it might get me another $3 in life insurance. With all of that said, everyone is interested in putting money toward this PUA rider in order to get as much cash value as possible. Because the thing I hear the most from people is, I'm interested in a whole life insurance policy, Steve, and I don't care about the life insurance at all. I'm like, totally get it. What they're interested in is the cash value. And the reason why is because when we look at the cash value, there are three core benefits. So here's why people are typically attracted to it. So cash value grows safely regardless of what's going on in the marketplace. A lot of people are attracted to the product during recessions. You can access the money anytime. And you have a unique loan feature in the sense that you're going to continue to earn dividends and interest on any money that you access if you access it through a policy loan. And then lastly, if we follow IRS rules, we can access that tax-free. So what I see here is typically corporations and wealthier families and individuals who are paying a lot of income tax attracted to the tax benefit. Because when you look at the returns, we track the performance of all the whole life insurance policies that we put in force. Typically what I see is somewhere between 4 to 5%. Some are doing better than that. We've got some policies on our books right now when we track the annual yield, it's around 5.5% per year. 4 to 5% is more conservative and sets expectations correctly, in my opinion. Where I'm going with this is if you're in a high tax rate, 40% tax rate, for example, what would you need to earn before tax? And then after you pay tax, you'd be left over with 4 to 5%. You probably need to earn somewhere between 8 and 9%. So what that means is if you can get 4 to 5% and we follow IRS rules and that's tax-free, that's going to be the equivalent for many people of an 8% or maybe even a 9% return that they would need to earn in a taxable account. So that has been a point of attraction for a lot of people who have examined the tax benefit of cash value life insurance, but that's just one benefit when we look at it. The key is, going back to this, setting up a policy the right way so you see cash value from start to finish. Here's the piece that creates the, oh, I didn't know that moment. If you're going to put in $10,000 per year, you can choose where the money goes, whether it goes toward the premium or toward the PUA rider. When most people are sold a whole life insurance policy, they are sold a policy where 100% of their payment goes toward the premium, whether it's 10 grand, 100 grand. I saw the worst case of my life earlier this year. Young kid who does extremely well financially was sold a whole life insurance policy where he was putting away $7.6 million per year, and it all went into the premium piece. He had a fat death benefit, but boy, did he lose a lot of money up front. So knowing where your money can go is the key. What we really want to know after I said that is what I like to call the rules of the game. There are two specific rules that you want to be aware of here. One has to do with the insurance company that you select, because all insurance companies have different rules. The other has to do with the IRS, because why people are attracted to this is when they can use the cash value tax-free. There's ways you can mess it up where you'll have to pay taxes on the cash value, which we don't want to do. So the IRS rules, there's a couple ways a policy can become taxable. If you cash it out and there's a gain, the gains will be taxable as ordinary income. If it lapses because you've loaned too much and you stop paying premiums and you're not paying any loan interest, it lapses, there's a gain on it, you have to pay income tax on the gains. Unpaid loan interest will also be counted as a gain. A lot of times people don't know that. So those are two examples. The popular example of a taxable event that most have heard of is what's called a modified endowment contract, or a MEC. We don't want a MEC. If a life insurance policy becomes a MEC, the cash value grows tax deferred. But if you ever want to access the cash value, you've got to pay ordinary income tax on it. And there's a potential 10% penalty tax if you touch it before age 15 and a half. A whole bunch of stuff we don't want. So how you prevent it is every policy has what is called a MEC limit. Let's put this up here. And it's exactly what it sounds like. It's the maximum dollar amount you can add to a policy per year without your policy becoming classified as a modified endowment contract. Think of it this way. If your policy becomes a MEC, that's bad. You'll have to deal with taxes if you want to access the cash value in the future. If your policy does not become a MEC, then it's very easy to access the cash value in a tax-free manner. So we don't want a MEC. How we prevent a MEC is knowing what our MEC limit is and then not paying in more money than that. Now, more steps. The MEC limit, we can set it wherever we want. What you will find is that the MEC limit has a direct relationship to your death benefit on a policy, specifically your death benefit and age. Those are the two main factors. Your gender and the guaranteed rate does have an impact on that as well. But the main impact of what's going to determine that MEC limit is the total death benefit in your policy and also your age. Now, a trick that you can use with a policy, and we use this trick almost every single time, is you can add what is called a term insurance rider to a policy, which allows you to get a lot of death benefit for a very, very low cost. And why we do that is because we know the death benefit drives the MEC limit. So I know this is a lot. I'm going to try and tie it together here. If you said, I want to pay $10,000 per year, that's the most I want to pay into a policy on any given year. What I would want to do, if I'm maximizing your cash value, is set your death benefit at the lowest amount needed to give you a MEC limit of at least $10,000. This way, I follow the IRS rules of the game. The next thing I would do is comply with the insurance company's specific rules. All companies have different rules. If you look at your 4 major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, the lowest we can set the premium is typically 10% of whatever your total payment is. So if you said, the most I ever want to pay in is $10,000 per year, then I know I can set that premium as low as $1,000, sometimes a little bit lower, which is cool. So why I do that is because the premium does not build cash value upfront. If I lower that premium, that lowers the upfront hit I'm going to take on my money. The premium drives the death benefit. If I just have a $1,000 premium, that might give me a MEC limit of $3,000 to $4,000. So adding that term rider for another $200 or whatever it costs will get my death benefit high enough where I avoid the MEC. But back to the insurance company rules of the game, a $1,000 minimum premium, nothing in cash value, a little bit of death benefit, that's as low as I can drive it. And then the other 9,000 or 90%, might be 88% because a little bit goes toward the term, but you see what I'm saying here. The rest, I add to PUAs. And the reason why is because that stuffs my upfront cash value, gives me the most long-term cash value, especially when you look at the guarantees. One thing I hear that drives me nuts by agents trying to increase the base premium is a higher base premium drives the long-term growth of the cash value. Yep, I've never seen corporations do that. We don't set policies up like that for corporations. And when I look at the actual results, that doesn't happen. Sometimes it might show that that could happen on an illustration, but I don't see that happen in reality. What I see produce the most cash value is when we push the premium as low as possible. Honestly, what this does too is push your commission as low as possible. So when I hear people trying to raise that, I'm wondering, why are you actually doing that if your consumer's goal is cash value? Anyway, this type of setup where we're driving that premium as low as possible does give us the most cash value because we're getting more money toward PUA. And the thing that I love about this type of setup is if my premium is $1,000 with some companies, I'll give you an example. Guardian's one of them, of the 4 major mutual companies. They're very, very flexible. So what this means is you can set it up where you are only billed for this plus the term rider, call it $1,200 per year. And then this, you can add at your leisure. So now, instead of having a boring bill, you set it up in a manner where you're only committed to $1,000 per year or $1,200 per year with the term rider cost. And then you dump in extra PUAs at your discretion, knowing you can hit a total of $10K per year. You don't have to. If you do, the cash value will look good. If you don't, the cash value won't look good. But when you follow this model, what it does is give you a very flexible policy in the sense that you're not committed to this big bill, but you can add more money if you want to. And when you do, you immediately see the impact of the cash value there, which is really, really nice. And then 2, it maximizes your cash value short-term and long-term. When we drive that premium down to 10%, typically what I see with the policy, the first year is still the worst year, but instead of 0, what you'll see in the first year is somewhere between 80 and 90%, meaning if you paid 10 grand, you'd see between $8,000 and $9,000. And then second, your break-even point, which is a fancy way of saying when you get all your money back, typically falls between 3 to 5 years. Sometimes it's 3 to 6, depending on the company, product, and our health rating, but we get our money back faster. Why people typically don't like whole life insurance is when they see a big hit on their cash up front and it takes a long time to get their money back. Because if I'm a business owner and I'm interested in using the loan feature and accessing my money, but it's going to take me 7 years just to get my money back, I'm like, it doesn't work. There's other things I would do with my money. The same is true with the big hit up front. Whereas if you minimize that, especially closer to 90% of my payment available immediately in cash value, I get my money back quickly. I see a 4 to 5% return long-term, along with the tax-free benefit. I can access it anytime via the loan feature and see my money continue to compound. And when we take loans, we'll analyze the cost to borrow and make sure my net growth exceeds the cost to borrow. If I'm doing that, I like it. And that's really what we do for business owners, for corporations, for anyone who's interested in a whole life insurance policy where cash value is the goal. But what I would do if you're going to get a policy to simplify all this, because I know it's a lot, is step 1. I would look for a policy that has between 80 and 90% of what you pay into it, of your total payment, available in cash value in the first year. Second, I would look for a break-even point, somewhere between years 3 and 5. If you're older, specifically above the age of 60, or if you have some health issues, maybe it's delayed to year 6, but I would look between years 3 and 5 in most cases. And then third, when it comes to the company selection, I would highly encourage you always to explore one of your 4 major mutual companies, who are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The simple reason why is because I've seen the best actual results showcased by them, meaning not an illustration on paper, but real results. A big form of buyer's remorse in the life insurance industry is overpromise and underdeliver. Nobody likes that. I've seen consistent results, also strong results from the 4 major mutual companies, which is why I like them a lot. Anyway, hope you enjoyed this video. If you'd like to see a video similar to this, but with some technical details and examples of actual policies, you can check out this one here.